So much for tuning into Talking Point. I'm your host, Neeraj Shah, and it's an interesting market wherein there is some bit of spurt in economic activity, at least in India. The earnings, while lower than estimated, or the number of downgrades being higher than the number of upgrades, the season probably hasn't turned out to be as eye-poppingly shocking as a lot of people would have believed it to be. And we've seen crude prices come off from the scary levels of 120, 125 odd to about $90, $95 per barrel. So the pulls and pressures equally out there. The question is there value in the market, or has it done the run up that it was probably that bulls wanted it to do? And what's the way ahead from here? Let's pose that question to Vinay Jaising. He's MD of Portfolio Management Services at JM Financial. Joins us on the show. Vinay, great having you. Thanks for joining in. Hope all is well.
Thank you, Neeraj. Thank you so much.
So, Vinay, what's your sense? We are no longer at 15,300, where there perceptibly was a bit of value. We've rallied about 2,000 points, but the world is looking a bit better than what it was back then. How do you approach the market? How do you assess the landscape?
So I'm going to question your question. My apologies. Why do we say the world is better? Is the war over? The answer is no. Has the QT finished? The answer is no. We're seeing double impact of the tightening coming in September. You're at about $40 to $45 billion of what US Fed has done. And that number has to go to about $97.5 billion on a monthly basis starting September. So two pain points coming up around the corner. The third pain point coming up around the corner, as you put it so beautifully, is you looked at it positively. I'm going to look at it a little negatively. If I had to look at earnings in the beginning of the quarter, I thought the EPS was X. Now I'll need to cut numbers by about 3 to 4%, which means whatever was the valuation at the 10% pop-up, we are talking about another 3 to 4% valuation being downgraded purely because of the earnings cycle. So we think there's been a beautiful bull rally in the short term, which in my eyes leads me to be a lot more cautious because interest rates are on the move up. Fed is doing what it's supposed to do, which is increasing the tightening. And the world is not yet into a situation wherein you want to be very positive the equity markets.
Okay. Yeah. So, okay, well put. And I'll kind of corroborate and kind of ask you how bad the situation can get in a moment. Let me first try and play the devil's advocate as I should. So some of the known factors out there, and I would want to assess the impact with you, as I said. But here's the difference from how I see it, maybe compared to what it seemed like about a month and a half ago. Crude prices seem like they will ratchet up to maybe 140, 150, who knows, and they could well still do. But for now, they've come off. The yields have come off, and higher interest rates are no longer the fear because the base effect, if anything else, would ensure that the US inflation numbers don't look as scary in the second half as they did in the first half. Does that make the market a bit more, how do I say, sanguine than maybe a month ago?
So absolutely, if the market was at the same level as it was a month ago. So Neerav, I'm going to again give you some data points. My apologies.
Please. We love data.
So think about it this way, right? When the 2-year curve of any interest rate is higher than the 10-year curve of any interest rate, what does that tell you? That tells you, I was seeing a movie, Clear and Present Danger. That's exactly what it tells you, right? So we are living in an environment wherein in the short term, we are paying a lot more than what we would pay for the longer term. And that is not comfort levels for us. So that I think is the single biggest factor, which is affecting us. Now, if you were to look at the Indian economy versus the rest of the world, I think full marks to the Indian economy. It's ticking a lot of boxes. And let's spend some time later on crude, because I want to spend some time talking to you about Indian crude, which is in a wonderful state. But we'll do that a bit later. Think about other situations like liquidity, equity liquidity. If the MSCI EM has just 13 to 14% as weightage for India, and India is up just last month by 10%, right? That's the absolute data. The world is up by 6% and China's down by 12%. The underperformance is so substantial that if you're an ETF, by default on a monthly basis, you'll start pulling money out of India and balance your portfolio. So remember, though we keep on talking about very big numbers of outflow having happened in the last year, $28, $30 billion, But that's not over. That's because India is outperforming so much, and more importantly, emerging market is underperforming. So unless the weightage of MSCI EM goes up for India, till then the trouble may not be behind us, Neeraj.
So can you actually talk a bit about this, because it's an aspect that not many people spend detailed time with, Vinay. In the same breath that the Indian outperformance has been stark, and yes, India has typically traded a premium valuation, but you're right, the valuation, the outperformance has been very stark. But we hear about a lot of EM dedicated funds, and Ruchi Sharma is probably just one out there. But some EM funds which are EM ex China are getting launched, and that would mean that the relative weightage of an Indian basket in such a portfolio, which is EM specific but ex China, would be even higher than what traditionally it would have been. So how do the two factors juxtapose and stack up against each other?
So I think you've put it beautifully. I had the pleasure of working with Ruchir for 22 years at Morgan Stanley. So due credit to him. Having said that, think about it this way, right? We were at $650 billion for FII money into the country at one point of time. Today, we are at about $550 billion, give or take change. Now, out of this $550 billion, very difficult to put a number, but let's just assume currently that 20%, only 20% of this is passive funds. And the rest are the funds which are the aggressive, active funds which can take bet anti any index. So it is that 20% or about $120 billion which can keep on moving up or down based on the movement of the market. That itself is a big number. So if India outperforms by 20%, 20% of $120 billion is $10 billion plus. So there's a lot of outflow and inflow can happen purely because ETFs are the name of the game globally.
That's true. Okay, so is your base thesis, Vinay, that there is a higher probability of never mind what's happened in the last 10 days, a higher probability of outflows continuing, because that's what we've seen for a better part of the last 9 months?
See, our main thesis is in the medium term, Indian markets will outperform absolute and relatively. The GDP story is intact. The corporate profitability of India is far higher than the economic profitability of India, and there's a total delineage of the two. We can spend some time on that as well. And that leads us to believe that India Inc., if I may use the word, is on a roll. Having said that, it also depends upon liquidity for the rest of the world, because of which I think we are relatively cautious, the Indian market. The valuations of India are at about 20 plus times 1 year forward, which is in line with its 5 years. Unfortunately, it's at a 90%, I repeat, 90% premium to MSCI emerging market as against the average of 45%. So that's why currently we are a bit more concerned than I guess the rest of the market.
Can you talk a bit about QT, because I think twice you've cited this in the last 10 minutes. And I think a lot of people talk about the interest rate rise and fall and the impact thereof. But the conversation around QT and what it could do, irrespective of what happens to rates, how can you kind of decipher that for us?
So think about the money supply in the system globally. If the money supply in the system globally runs from the money supply in US, and that keeps on reducing, it's exactly opposite of what happened when COVID hit us. We classically, I sometimes feel in a similar situation today as we were during the COVID time. The difference being one, during the COVID time, the government was with us, which is why the markets sang, and the valuations were with us, which is why the markets did well as well. So the government kept on printing money in US. There was $5 trillion of money which was printed in US. The US balance sheet exploded up. Today it is about $9 trillion. As a percentage of their GDP, it's a big number of over 30%. Now that has to be unwound because you have to wait for the next calamity. Because it has to be unwound, around $1 trillion every year being unwound, and a fiscal deficit of another $1 trillion which they want to spend in the economy, means $2 trillion is being unwound on a yearly basis by US. Where does that money go from? God alone knows. But a bit of it which came into the equity markets now will be questioned and probably be taken back. So that is the risk of QT, world over, not just in India.
Yeah. In which, Vinay, does never mind the short-term gyrations, but by the medium term, I mean the next 18 months. I mean, I think anything over 18 months these days is long-term, simply because of the way the world is moving. But does India kind of stand out a bit more favorably? And I'll use two things that you mentioned in this question. One, that the stock market is arguably the nifty, the developed sector or the organized sector, which is faring very well, even if the rest of the economy may or may not. And two, the point that while crude prices are high, you yourself mentioned, I mean, the fact that India is able to buy Russian crude at a much better price and maybe at a slightly sweeter spot than the rest of the world, does that kind of cushion the Indian economy from what normally would have been a bigger blow?
Absolutely, without a question. So think about it this way. Let's again talk a little bit of data. Indian corporate profitability as a percentage of GDP pre-COVID was 1.7, 1.8%. Last when I checked the data, it had crossed 4.5%. Does it mean the GDP has gone down, or does it mean Indian corporates have gone, profits have gone up? And I think it's the latter. Indian corporate profits have increased by over 25% per annum for the last 2 to 3 years. CAGR. Now, if I were to look at 2000 to 2019 or 20, India was a growth story wherein the earnings never came. You had 6 to 8% of the earnings growth on the profit front. Now, 2018-19 to date, you're seeing a number, as I mentioned to you, especially in the last 3 years, of about 20 to 25%. So the earnings trajectory is fantastic. So India has finally become an emerging market, high earnings growth story. So you kind of tick the box when it looks at India and investments into India compared to the rest of the world. So that is why the outperformance of India versus the rest of the world, in my eyes, is relatively a done deal.
Got it.
And the second point on crude, and let's spend a minute on that. Remember, we talk about Russia and the war. What we should remember is pre-war, India consumed only 0.2 million barrels per day from Russian oil, just 0.2. People think it's China which had the gain, but China always consumed about 32 to 33% of Russian exports. Russia produces about 10.2 million barrels per day. Half of that was exports, and a third of that went to China. Today, a fifth of that, 15%, comes to India. Now, I won't get into the cost of which other country, has taken over that and coming to India. But what's important is you're getting crude for 15% of your demand at about $70 to $80 per barrel, which is amazing. So that is clearly a good, I would say, soft cushion for the Indian crude oil story or the consumers compared to what it earlier used to be.
Got it.
That's a plus point.
Sorry. Vinay, sorry, I'm making you talk a lot while you have a bad cough, but be that as it may, I'll still be greedy and put in maybe 3 or 4 more questions before we wrap up. So first, I understand. So you are a bit circumspect because of the run-up that we have seen. Do you reckon that this therefore remains or becomes a market which has moved out from a sell-on rally to buy the dip? I mean, albeit it could be a slightly bigger dip from the current 17,500 circa that we are at to maybe 10%, 15% as the case may be. But does that remain from a medium-term perspective a buy on dip market?
Absolutely. So India is always a buy market. The question is, if you get something cheaper, why not? So absolutely, but this is for a global investor. For a domestic investor, we would advise to keep some cash so that you can actually take advantage of the dip when you get into the market.
Got it. You expect a significant dip, Vinay?
Well, I'm hoping not. But having said that, I think the next 3 months are telling. We will probably touch the last time's lows. Today, we are close to 7% below the peak. At one time, we were close to 15% below the peak. So can we resurface those levels of 15,500? I will not be surprised.
You will not be surprised. Interesting. No. Okay. And what gets decimated in that process? 15% on the headline would mean maybe 25, 30, 40% for a bunch of others. So what gets impacted the most, you reckon? Because there are some spaces which are actually showing promise of earnings growth. And in the same vein, there are some high-flying performers which have some headwinds. So have you kind of tried to put your head around that?
I'm going to give you the answer the other way around. If I look at the quarterly results, what excited us substantially was the financials. Now, financials in a way is 30% plus of an index weightage. And if that grows at 50 to 55% of the 280 odd companies results which come out, your base impact looks like a solid 12, 13% year-on-year growth. You take that out and virtually you have no growth in the rest of the market. So that's the part we would be bullish on, and especially banks, the private sector banks. That's where we're seeing the credit growth gone from 5, 6 to about 13% on the loan book. You're seeing interest rates move up as well, which basically means if the capex cycle in India takes off, you're in a very, very positive mode as far as banks is concerned and capex centric companies are concerned. So that's where we would put our eggs. On the other part of your question, what would we avoid in these kind of markets? Markets where, see, the currency today is 80. But unfortunately, if you depend a lot on US for your dollar, as far as your order book is concerned, we don't want to play the trade. So we would be underweight the IT sector, though a lot of it has corrected. We like the big ones, but we won't be equal weight on that space currently.
Got it. Vinay, it's a pertinent point. Financials, the commentary and the performance was strong. I'm glad you mentioned capex, because I thought manufacturing and if you look at the bearing companies' commentary or the performance of some of the others, it kind of laid fruit. I was wondering if you thought the pockets around discretionary, direct to consumer consumption and urban discretionary consumption also appealed to you, because I thought the numbers compared to current quarters or compared to even pre-COVID levels, they are ticking some fairly decent numbers out there.
Absolutely. So our big theme, if you would ask me the other way around, is the India resurgence story. So what we believe is the India resurgence story is the first one that I mentioned to you, which is private banks, but more importantly, the auto sector or the bearing sector. Just think about it, right? Commodity prices are down and out, 30 to 40%. Demand, you want to buy a new car, you want it tomorrow morning. You've seen what had happened in COVID. Companies like Maruti tell you they have a 1 quarter of backlog of order booking to be done, which means it will only get built. So technically, the auto sector is finally in a sweet spot wherein demand is there and raw material prices are moving down. You move down the thing, capex and some industrial companies, because capexes are now increasing by in particular sockets, also have order books which have gone up like crazy. So I would buy the India resurgence story. One last comment, marriages are on the rise. Now, if marriages are on the rise, think about the food, the cold drinks, the water, which you're consuming. So, a big story there of companies also is part of our portfolio.
Great. Vinay, thank you so much for taking the time out today and being with us. Yep, have a great quarter ahead.
Thank you so much. Cheers. Appreciate your time.
Yep. Thank you. And viewers, thanks for tuning into this leg of the Talking Point.